So, you're a G-4 visa holder and you're selling your home in the United States. You've lived in that home for many, many years. You just can't wait to receive that very large check from the settlement agent. You get the check, but then you notice it's much smaller than you expected. Why? You forgot about the Foreign Investment in Real Property Tax Act, or FIRPTA withholding for short. In this episode, I'll explain FIRPTA tax withholding and how to reduce its impact on G-4 visa holders. You see, if you are a G-4 visa holder, it's very likely that you're a non-resident for U.S. income tax purposes. See my other video related to how to determine your residency status. Most G-4 visa holders that are living in the United States may qualify for the $250,000 principal residence exclusion. The general rule is that you are able to exclude the gain from tax of up to $250,000 or $500,000 if you own the property jointly. You must have lived and owned the property for at least 2 years out of the previous 5 years prior to the sale. Therefore, most G-4 visa holders and their spouses who live with them will likely not be liable to any income tax on the sale of their principal residence. This exclusion is generally not available for rental property, and therefore gains from the sale of any rental property owned by a G-4 visa holder will usually be subject to U.S. income tax. So now let's get back to FIRPTA income tax withholding that G-4s will have withheld from the sale of their property. Remember, even if the G-4 owes no ultimate income tax, the FIRPTA income tax withholding is simply a withholding tax and not a final tax liability. Well, how does this work in practice? If you're a G-4 visa holder non-resident and you sell any U.S. real property, a home or a rental property, a 10 or 15% income tax will be withheld based on the gross sales price of the property, and that withholding will be done by the buyer or typically the settlement agent. When you sell that property, whether the FIRPTA withholding tax rate is 10% or 15% will depend on whether the buyer will be using the property as a residence or a rental property. And also, it'll depend on the gross sales price of the property. Assuming the buyer will use the property for personal purposes, in other words, not treat the property as a rental, then a 10% withholding tax should apply on the real estate with a sales price of up to $1 million. A 15% withholding tax will apply under FIRPTA if the sales price is more than $1 million or if the buyer will be using the property as a rental property. Then the withholding tax will always be 15%, regardless of the sales price. Now let's talk about how you get your withholding tax back. Let's assume, as I said before, that you use the property as your principal residence and you meet the requirements for the gain to be excluded from income tax. So you should have absolutely no income tax liability. How do you get that withholding tax back? There are 2 ways to do this. The first one is called obtaining a withholding certificate. An IRS Form 8288B is used to request a withholding certificate from the IRS that will allow for the settlement agent or the buyer to refrain from withholding if the certificate is issued by the IRS before the settlement date, or will allow the buyer or settlement agent to first withhold but then give the withholding back to you if the certificate is issued by the IRS after the settlement date has taken place. The 8288B may be completed and sent to the IRS as soon as you have a contract for the sale of the property. The IRS takes up to 90 days, sometimes actually longer, but they're supposed to take only up to 90, to complete the 8288B and send the approved withholding certificate back to the settlement agent so the agent can then provide you with a refund of the tax withheld. The second method, and perhaps the easiest method of obtaining a refund of FIRPTA withholding, is simply for the G-4 visa holder to file a non-resident income tax return for the year on Form 1040-NR. The tax return is completed showing the amount of the taxable gain, if any, from the sale of the property. The tax is computed, and if the actual income tax is lower than the FIRPTA withholding, which it usually is, then a tax refund is issued by the IRS. However, the tax return cannot be prepared until the forms for the year of sale have been published, which is usually January or February of the year following the sale. So which method of obtaining a FIRPTA withholding refund is preferable? It usually depends on the time of year the sale of the property takes place. Generally speaking, if the sale of the property takes place early in the year, it usually makes a lot of sense to use the 8288B method. Since if you use the tax return method, you're going to have to wait probably almost a year to get your income tax refund. And so your funds will remain with the IRS much longer than using the 8288B method. So I hope that this has been useful, and please don't hesitate to contact me if you need any assistance with FIRPTA. Thank you very much.